Welcome to the seminar on Understanding Credit, brought to you by Alaska Air Group Credit Union. What you'll learn today is 4 different things. The first thing we'll cover is understanding credit, and we'll learn things such as what is a credit score, 5 factors that determine your credit score, and establishing credit. Next, we'll cover the credit score scenarios, the impact on a consumer with a 780 credit score, as well as an impact on a consumer with a 680 credit score. Then we'll jump into how your score is affected and the impact of a mistake, how to protect your credit, credit monitoring, freezing your credit, fraud alerts. What is a credit score? Determining your borrowing ability. Credit scores range from a low of 300 to a high of 850. They help to reflect a borrower's ability to pay for services or repay loans. Borrowers with high scores get favorable interest rates and easy access to credit. Borrowers with low scores may pay higher interest rates or be unable to borrow from traditional sources. The best known credit score is the FICO score, or Fair Isaac. It's being used by TransUnion, Equifax, and Experian, the 3 major credit scoring companies. Let's go ahead and look at the various credit score ranges. So if you have a credit score with 740 and above, you're considered excellent. If you have a 700 to around 740, that would be good. From 640 to 700, that'd be considered moderate. If you have below 640, this will limit your options as a borrower and will require credit repair. Let's go ahead and look at the impact on a consumer with a 780 credit score. This is all just an example, not reflective of current rates. So the scenario we have here is a FICO score of 780. The person has a car loan at 2.49%. Car loan for that loan is, let's say, around $20,000, and they're paying around $350 a month. And then so the total interest on that car loan is around almost $1,300. And then let's also apply, this member has a mortgage loan at 4% and $200,000 loan, right around $1,000. Total interest paid over the life of the loan, $143,000. Keeping in mind that it's probably a 30-year mortgage. So let's say this member has a late payment for 30 days. What kind of impact is that going to have on this member? Okay, most likely they're going to drop their credit score from a 780 to around a 690, so nearly right around 100 points almost. And now if they go out to get a car loan, they'll probably expect around a 1% bump on that interest rate, which will impact their car payment by about, doesn't seem like much, but maybe $10 a month. And the total interest, though, over that life of that loan will bump up another $500. Now it gets even tougher when you get to the mortgage loan. So now you're below that sweet spot of around 720. So it might become a little harder to get the best rate. So now your mortgage rate goes from 4 to 4.375. Now you're paying around $1,000, and the total interest paid is almost $160,000. So significant differences there. Keep in mind, let's say the scenario is you have a late payment, but it's not on a regular loan or something else. Let's say it's a late payment on your mortgage. What's going to happen? Okay, it's going to drop even more. So just one late payment on a mortgage loan, just only the mortgage loan, is going to go from 780 to 630. Now let's just say you have a 630 credit score. What kind of interest rates are you going to get for that car loan? It's going to jump all the way from that 249% to 699. And then the monthly car payment is going to jump all the way to almost $400, from around $350 to $400. And the interest more than doubled, almost to $3,800 a year, or not a year, over the life of the loan. And for the mortgage, you're going to jump from 4% to 4.75 if you can find it. And the mortgage monthly payment's going to jump up around $100, but over the life of that loan, it's going to go to $175,000 in total interest paid. So significant differences between a regular 30-day payment, missed payment, as well as compared to a mortgage. But you can see when you have a higher credit score, quite a huge drop just by that one missed payment. So let's look at a very similar scenario that we just looked at before. However, in this scenario, we have a member with a FICO score of 680. So they have a 680 FICO score. Let's just say they can get their auto loan around 499. Monthly payments around $377 a month. Overall interest, $2,600. Mortgage, 4.375, right around $1,000 a month, and then total interest over the life of that loan, almost $160,000. So we've established who this member is. So let's just say this person has a 30-day late payment. What kind of impact? We just looked at the 780. Let's look at this. Okay, so it's going to jump from a 680 credit score to a 620. And then obviously that 620, the loan, car loan interest rate will probably jump about 2%, possibly more. But the monthly car payment will jump up, of course, because higher interest rate. Total interest paid on that would be around $3,800, and then for the mortgage loan to 4.75, a little over $1,000. But overall, that interest jumps up by about $15,000 more than what you would have before. And that's just on a 30-day late payment for any type of loan. Now let's go ahead and look at the same scenario, but with a mortgage loan. From a 680 to a 580. Okay, so now you have a car loan. It's going to go from 499 all the way to 1099, around 11%, and car loan monthly payment from 377 to 434, and over the life of that car loan, instead of 2,600 in interest, you're over $6,000 in interest, and you're most likely, if you're trying to get a mortgage loan, purchase that first home, whatever it may be, you're most likely going to have a very difficult time finding someone that will lend you that money. One thing to note, from the 680 to the 720, the range there is a bit less. Previously on the 780 credit score, when there was one late payment, it was around a 90 point drop, and here we have it going about 60. So once you're kind of lower, it'll drop, but it won't be as big of a drop, but still, these are all negative drops. It's going to impact your score, and you can see how quickly the lower you go, the harder it becomes, and the more interest you're going to have to pay. So it's so important to make sure that you're always paying your loans on time and taking care of your credit. It can save you tons of money. All right, now we're going to look at the 5 elements that determine the FICO score. Those 5 elements are payment history, which represents 35% of your credit score. And the next element is capacity, which represents around 30% of your credit score. And you have new credit, that's around 10%. Length of credit is around 15%, and types of credit used are 10%. Now we'll go ahead and jump in to look at each of these elements in greater detail. First element we're going to look at is payment history, which does represent a huge part of your credit score, 35% approximately. This represents any bankruptcies, judgments, liens, collections, suits, and wage garnishments. Number of accounts paid as agreed. Late payment information includes number of past due items, how long those items have been past due. And keep in mind that when you're making your payments on loans, that does help to support your history. However, let's say you're making your payments on medical bills and things of that nature, that's not necessarily, and your utilities, that's not necessarily going to make its way to the credit score unless you start not making your payments and you're past due. So you're not going to get credit for all that good stuff for some of those payments, for the utilities and medical, but if you don't make those payments, it's going to hurt you. So you're getting credit and you're building your credit score with those loan payments, but you're only going to get hit when you're not making your payments on everything. So it's very important to make all your payments and recognize that having a loan and establishing credit is very important to help establish that history. The next element is the capacity. So we reviewed that earlier. It's around 30% of your total credit score. It helps to show how much the total amount owed to all creditors, as well as how much available credit you have. So one thing to keep in mind, it's not a good idea to max out your credit. That can actually hurt your credit score. So just because you have a credit card that has, let's say, a $20,000 balance doesn't mean you should, or line of credit limit doesn't mean that you should borrow a full 20,000 and keep that. You try and keep the balance right around 30% of what you have on that line of credit. I know it's going to sometimes go up and down, but please keep in mind the more you borrow against it, and that will negatively impact your credit score. Next area we're going to look at is the length of the credit history, which makes up about 15% of a person's credit score. Things to consider about your credit history are when your credit file was established, how long individual credit accounts have been established, age of the oldest account and the average age of all the accounts, and how long it has been since certain accounts have been used. So it's really important if you had a credit card, like your very first credit card, maybe it was a department store or something like that, to keep that card active and to use it periodically so they don't close it on you. Also, that you consider the impact if you were wanting to close it, because if you do close that first card, it could drop your score by 30 or 40 points because you're going to lose all that history that you had. And also, it's really good to consider, let's say if you have kids or you're a young adult and you're looking to establish credit, maybe getting a small credit card for a gas station or something of that nature, or a department store, and using it a little bit and kind of building that credit history. That's a really great way to do it and show that you're a good borrower. Next, let's go ahead and look at new accounts, and that helps to determine about 10% of your score. So how many of your accounts are new? The ratio of new accounts to established accounts, how long it has been since a new credit account was established, how many credit inquiries have been made on your credit file, how long has it been since these inquiries were made. So those all can impact your credit score. Keep in mind, if you are out shopping, say for a new vehicle, and you're going to several dealerships, which is in making sure that you're finding the right vehicle for you, and they're running credit, maybe at every single one of these dealerships, and over the month maybe it's ran several times. Well, the system is smart enough to recognize that you're looking at all of these, your car shopping. So it's not going to necessarily hit your credit score every single time and negatively impact it. Now, if you're looking to get a mortgage loan and you're in the process of purchasing your first home and you had your score ran and everything checked out fine, but then you're really excited, and during that month or 2 months until the final closing, you go out and you get a new credit card, or you look to get a new auto loan or something like that. That's the last thing you want to do, because that could negatively impact your credit score. You're going to want to wait till everything's done, and then the house is closed, and that way because right before they close that mortgage loan, they're going to be pulling your credit again. And if you've gone out in between the first time that it was pulled and the last time it was pulled, there's an opportunity for that score to go down. If you're, whatever it is, like I said, a new credit card, auto loan, or maybe you're going to some furniture store or something like that because you're excited, wait till after everything's done and then jump into it. So you have to be very aware of that and kind of use new accounts wisely, new lines of credit wisely. And lastly, we will look at the types of credit used determines approximately about 10% of your credit score. So a mixture of account types generally scores better. So this type includes credit cards, installment loans, which same thing as an auto loan. You have mortgage loans and finance company account, retail, accounts like your department store. So just kind of having a nice blend, not having a zillion credit cards, things of that nature that can negatively impact your credit score. So keep that in mind and keep it balanced. Plus, it's a lot more to keep track of if you have so many different credit cards and loans all over the place. Keep it simple. Let's look at what you should do to help establish good credit. So what you need to do is pay bills on time, establish regular savings, maintain a checking account without overdrafts, review your credit report for unpaid debts, set up a repayment plan on unpaid debts, auto transfers, things of that nature. Maintain low balances on credit lines. As mentioned earlier, like you have your credit card balance and you want to keep that right around 30% of your total limit. Negative impacts on your credit score. So missing or late payments, maxed out credit cards, closing credit lines, shopping for credit excessively, opening up multiple new accounts, using too many revolving loans, bankruptcy, foreclosure, or short sale. All right, something to note and not be fooled by. Not every institution reports to the credit bureaus, especially like payday lenders. They have their own scoring system, and so you may think you're building your credit history with the FICO score and all the major bureaus. However, you're most likely not. And also, not all financial institutions report to all three credit bureaus. Some might report to one, two, or possibly all three, so keep that in mind. Things that don't affect your credit score unless they go to collections. Your age, income, bank overdrafts, rent payment, insurance payments, child support or alimony, utility or cell phone payments, checking your own credit score, fringe financial providers, current interest rates, and credit counseling. Now you've worked so hard to build up your credit score, and the last thing you want to do is have somebody get your information and use your credit score, open up false loans, do bad things, hurt your credit score. It's a very painful process to reestablish that, and it's just going to take a lot of work. And to avoid a lot of that, you can do several things. So we're going to look at monitoring, freezing, and setting alerts. So who do you contact if you're looking to monitor your information? So you're going to need some things. Who are the nationwide credit reporting agencies? You have Equifax, Experian, and TransUnion. And what information will you need to provide to them? You're going to need to provide your name, your address, social security number, date of birth, and previous address if you have moved in the last 2 years. Monitoring your credit score. So as you're monitoring, you can receive a free credit report every 12 months. So after you've logged in, given all that information as noted on the previous slide, you can get a free credit report every 12 months. What we recommend is that you consider staggering your free credit report every 4 months to help increase your monitoring. So there's 3 bureaus, do one every 4 months. And the 3 agencies did create one website for consumers to request copies of their credit reports. So you can visit annualcreditreport.com or you can call their number 1-877-322-8228. And note, if you find an error on your credit report, there should be a dispute form at the bottom of the report. All right, now let's look at freezing your credit score facts. It does not affect your credit score. You can still pull your free annual credit report. It does not keep you from opening a new account, applying for a job, or renting an apartment. And if you request a freeze online or by phone, the agency must lift it within an hour. So because of that time frame, it's pretty quick. So if you are applying for a loan or looking to rent an apartment, any of those things where they're going to need to pull your credit score, make sure you find out which credit bureau they're pulling it from. Go ahead, call or go online, remove the freeze. Once it's all done, they've pulled your credit. then you can re-add it again. And it can take up to no more than 5 business days to have that freeze added. More freezing your credit score facts. Keep in mind that it does not prevent a thief from making charges to your accounts. It does help to prevent a thief from opening up accounts with your information. Fees can range between free and $10 depending on the state when you're freezing or unfreezing. I believe most states have moved to the free. And some states, the credit freeze might expire after 7 years. And try and only lift that freeze from that particular credit agency for that job or whatever it is that you're needing to have your credit score pulled, and then putting the freeze back on. And it's also a good idea to consider freezing your kids' accounts. Keep in mind that especially children under 16, there's some additional steps you'll need to take as far as documentation and proving that you're the parent or the guardian. Let's go ahead and look at credit report fraud alerts. Fraud alerts allow creditors to get a copy of your credit report as long as they take steps to verify your identity. The cost is free. There are 3 types of fraud alerts. There's the initial fraud alert, which protects credit for at least 90 days. There is the extended fraud alert, which protects credit for 7 years. And there's the active duty military alert, which protects credit for 1 year. Now we have the credit reporting contact information. Here we have the address, web address, the phone number for ordering a credit report, as well as the phone number for reporting fraud for all 3 bureaus, Equifax, Experian, and TransUnion. Here we have some credit reporting additional resources, some good websites with the consumer FTC regarding credit freeze facts, USA.gov, identity theft, mycreditunion.gov, addressing credit report scores, and also the Washington State, if you're a resident in Washington State, information about credit freeze and fraud alerts. So let's do a little bit of a review. So how to improve your credit? Remember to pay bills on time, reduce the amount of debt you have, keep your credit card balances below 30%, apply for and only open new accounts as needed, have a good mix of installment and revolving debt, be smart about closing credit cards. So how can your credit union help? Well, here at Alaska Air Group Credit Union, we can help you with refinancing your home or auto loans with lower interest rates, provide a full spectrum of free checking and savings accounts. We have lines of credit, help you consolidate, free online banking, free online bill pay, mobile app, payroll deduction, automatic funds transfer. We have a great budgeting tool called Money Desktop. If you have bad credit, we can help you with direct deposit, share secured loan, basic credit counseling. We manually underwrite our loans, and we have a special loan that's a credit builder loan, help to build up that credit score. So if you have any questions, don't hesitate to reach out to us. Thank you again, and please know you can reach us at www.aagcu.org, or you can call us at 206-824-9800. We look forward to helping you.